Interesting time out learning financial reporting, starting right from the source document to the statement of cash flow. So right here are our transactions that we'll be making entries with. Okay, so this business is Mass Pastry Enterprises. Mass majors on cake, meat pie, and others. So in our transactions here, so in real life situation, they can be in bank statement or invoice and bill document. Alright, so at the first date we have capital raised for the business. The next, loan. Max took a loan to augment what he has to start up the business. Then the shop rent, which is about 100,000. Then mixer for the floor, and also ingredients and transport. And in the end, he made a sale worth of 400,000. Alright, so we'll now go to the ledger account so that we can make the double entries. So as the rules imply, for every debit entry, there must be a corresponding credit entries. So, but one thing I need you to know that, so that you get mastery over the posting of double entry, is that, okay, have it in mind that any form of transaction that is meant to bring in cash, that transaction is meant to be credited. Okay, for instance, sales. When you make sale, you are expected to get cash. So it gives you that you are going to credit it. And in other way around, cash will be debited. So like we all know, you debit the account that receives and you credit the account that gives. So like I said earlier, so in order to get it right always, any transaction that comes up, think of it in such a way that if this transaction is bringing in cash, so you need to credit the account. Then the cash account that is bringing, which is the corresponding account, you debit it. Okay, let's do it this way. Alright, we have a capital raise of 200,000. So how do we do that? Okay, the implication of capital raise is that we'll be getting a cash of 200,000. So it implies that we'll credit our capital account. So how do we do that? You hit your equal to, then you tap in your amount for the capital at your credit side. Okay, right up here. So the corresponding debit entry, which should be in the cash. So we put it up here and hit our equal to, then hit the amount of the capital. Correct. So as you can see, we've made the double entry for this transaction. So the next, the loan. Like we all know that a loan is supposed to bring in cash. So this is the loan ledger account. So we have our equal to right here, then hit enter. Correct. So let's make the corresponding debit entry. We get to the cash, then hit our equal to, then hit the loan amount. Good. So the next, we have shop rent. So absolutely, when you make a shop rent, when you pay for the shop rent, definitely what happens is that cash is leaving you. So this kind of transaction is taking out cash. So what you do about this is you debit this account, then you credit cash account. So let's have it right here. This is rent account, so we're going to debit it because it's taking out cash. So we hit our equal to, then the amount 100k, we hit enter. Right, so the corresponding entry, which will be in cash, and this time around is going to be credited. Yeah, so we hit it right here, then equal to, then the amount for the rent. Correct. Then we have our double entry. So the next on the line, we have the mixer. Okay, mixer is basically an asset for mass pastry business because it's meant to be used for over more than 1 year. So it's not just an expenses, but rather an asset. So an asset is supposed to be taking out cash when you purchase them. So we'll have it in the debit side. So we hit here in the mixers ledger account, then you hit your equal to, then we select the amount, hit. Absolutely. So they double the corresponding entry in the cash account, which should be in the credit side. So we hit right here, then equal to, then pull up the 70K. Good. So the next we have an expense for ingredients and transportation. So we have it about 100,000. So this is an expense. Okay, like we earlier knew that expenses and transport is supposed to take out cash. So we're going to have it debited in their ledger account. Okay, right here we pull it here, our equal to, then we hit our amount. Good. So let's make the corresponding entry, which will be at the credit side of the cash. So we hit here, equal to, then we pull it up. Yeah. So the next we have the final transaction, which is the cash, the sales rather. So sales is meant to bring in cash, because when you make sale, cash is getting into the business. So right here, the sales account will be credited. Here we put our equal to, then pull it in. Yeah, it's up here. So the corresponding entry at the cash. So we hit your equal to at the debit side, then pull up the 400K. Yeah. So we're done for the ledger, as we can see. Yeah. So all our ledger accounts are set. So basically every transaction is meant to have their own accounts. Okay, now let's total what we have in each of the accounts, the ledger accounts. So let's start up here. So you can drag from the top to the equal column, then you hit your summation. Right, we have up here 700K, then at this side we drag from the top right here. Okay, we have at the credit side, meaning the cash that left is about 270, then the cash that entered 700K, right? So the next account, the capital account, let's pull the total. We just only have all right, total of 200K. Here likewise 100K. Then we are trying to balance up the individual accounts. 70K at the mixer, then the rent. You have your total, hit your summation right here. So let's pull down a little. So the sales accounts have total of 400K. Hit our summation right here. Then the ingredients, a summation as well. All right, that's all about it. Okay, we balance up the individual ledger account. So we're going to switch to the trial balance. So basically, we primarily know that the essence of why we put out our trial balance is to ascertain that all the entries made right here in the ledger account are accurate and correct. So because of the principle of double entry that entails that the credit side must equal the debit side. So in this regard, all the entries at the debit side will be made at the debit side of the trial balance, while all the ones at the credit, the corresponding credit entries will be put at the credit side, so that to ensure that our entries are accurate and correct. So let's start. So for the cash, so how do we do that? Definitely we're going to use the balance. So how do we get the balance? We have to minus the debit side from the credit side. So the difference is our balance, and definitely we are about to have debit balance because the debit side is way much than the credit side. So let's put it up here. You put your cash. Okay, let's start from capital since we have it arranged from capital to down. All right, our capital is 200,000 at the credit side, right? So let's put it up here. Capital equal to, then hit up our capital. Yeah. Then the next, the rent. So how much is the rent? The rent account is 100,000 at the debit side. So we pull up our cursor here, hit equal to, then bring up the rent amount is up here. Then the next we have mixer. So how much is our mixer? Mixer is 70K. And mixer is a debit entry. So how do we do that? We hit right here equal to, then pull up our mixer up. Correct. Then the next, the loan. Definitely loan is a credit entry. So how do we do that? You hit your equal to, the loan right here 100,000. So we hit it in. Then the ingredient and transport. So we'll bring it up, you hit your equal to, and definitely is a debit entry. So you hit it this way. So the next, our sales. Our sales is a bunch of money, 400K. So it's a debit credit entry. So you hit your equal to, then your sale right here, hit your enter. Correct. Then the last, the cash. Okay, we said earlier that we are going to use the balance because the cash account has the credit and debit entry. So we're going to use the balance. So definitely the debit side outweighs the credit side. So we're going to have a debit balance. So how do we do that? You subtract, hit your equal to first, subtract the debit minus the credit. All right, let's hit our enter. Correct. So we've done with our entry. Okay, like I said earlier, the essence of trial balance is to ensure that our entries in individual accounts are right, accurate, and correct. So let's see about it. So we pull them up from right here, then summation, let's add it up. Good, we have 700,000 at the debit side. So the credit side, let's see about it. We are supposed to have the same amount. So we pull it right here, then we hit our summation. Good. So definitely our entries are absolutely correct. So we are having equal debit and credit side. Absolutely nice. So let's move to the next. All right, so the next schedule is the income statement. And you know the reason why we do this. So this schedule is prepared in order to know the performance of the business, whether Matt's pastry business is making profit or is just operating to survive. So how do we do that? We compare the revenue and the expenditure to know whether he's making a profit from his operation. So how do we do that? We plug in the revenue and the operating expenses, then match the difference. So let's start. So the revenue is up here. So the revenue is basically the sale. So we put sales right here, under here, sales. Then the amount. How much is the amount? You put your equal to, so we have it in our trial balance. So we pull up our sales, 400K is up here. Then the next category, the operating expenses, because basically the only revenue right here is only the sale. So we don't have any revenue like rent income or any other income. So Matt's Pastry only has one source of income, which is the sales of his pastry product. Okay, so right here we have the operating expenses. So which are the expenses we have right here? We have a bunch of them in this situation. So we'll put them down one after the other. So we hit our enter right here. So we'll bring in the first expenses right here is the rent. So we'll bring in rent. Rent is right up here. Then the amount of the rent. So how much is it equal to? So rent is about 100K. So we'll bring it in. The next expenses. So mixer, like I told you guys earlier, that mixer is an asset. So it's not an equipment that is meant to be exhausted in a particular year. So it's meant to be used for over 1 year. So the next thing we have as an expenses here is the ingredients and the transport. So we bring it in, so we hit our equal to right here, then plug our ingredients right up. Correct. Then the next expenses, so that's all. I think we have a couple of it right here. So we hit the amount of the ingredient, hit your equal to, then bring it up, 100K, right? So let's see the total of our operating expenses. So we'll pull it from the top to the down right here, hit our summation. So let's get up to our net income. So the difference between our revenue from sales and our operating expenses will give us how the business has performed, whether it's making profit or it's just struggling. Okay, right here we hit our equal to, then our revenue minus our operating expenses. So you hit it. All right, so we have a net income of 200K, meaning that this Mass Pastry Enterprises is doing nicely. All right, so the next one, this next schedule is a statement of financial position. So this schedule is made out to know the standing of the business. So at the end of the period, so you need to know, Mass Pastry Enterprises need to know their stand, what the business owe and what the business own, right? The asset is what the business own, and the liabilities are what the business owe to the outsiders. So it's necessary to figure out the standing of the business at the end of the period. So that's the basic need for this schedule. So how do we do that? We bring in our assets. So definitely we have a couple of assets for this business. So we pull up our cash, because cash is definitely an asset for the business. So we'll put our equal to right here to the trial balance so that we get our cash. All right, our cash is all down here. We bring it in. Then the amount, how much is the amount? So plug in our equal to right here, then the amount of the cash is up here. Then the next asset is a mixer. So mixer was bought for the production of the pastry products, which is meant to be used over years. So we bring it in, the mixer is up here, then the amount, how much is it? So let's plug it in, 70K. So pull in the amount right here. All right, so these are the amounts for our assets. So let's pull them up and see the total amount of assets Mass Pastry Enterprises has. All right, so Mass Pastry Enterprises has an asset worth of 500,000. So we switch to the next category, which is the liability. So the liabilities are definitely what the business owes to the outsiders. So we have one right here, the loan. So we bring it in, we pull in our equal to, then to the trial balance, we bring it in, hit enter, correct. Then the amount right here, pull our equal to, then 100K for the loan, we pull it in. So I think this is the only liability the business has. Okay, so let's move to the next, the owner's equity. Owner's equity are what the owners or what the business has, the financing aspect of it, definitely the capital, the profit, because at the end of the period, the profit is for the owner, and the amount that is used to start up the business is for the owner. So definitely these are his equity. So with this, the equity is used to finance the asset and other current assets. All right, so let's do them right here. So we'll pull in our capital, the startup capital equal to. So it's right up here. We bring the narration, then the amount. How much is the amount? Pull our equal to. Then the 200K right up here. Then the next is the net income, definitely. But the net income will be picked out from the income statement. So we drop it right here, equal to. Then the net income, plug it here. Then the amount. How much is our net income? So we plug in our equal to. Then bring up the 200K right here. We hit enter. So I think we're almost done with our balance sheet. So now let's match up the total of the asset and the liability. Right up here we have 500K for the asset and 500K for the total equity and liabilities. Definitely it is correct. So this implies that these assets, the asset of the business, including the cash and whatever the business has acquired, was financed using the equity, what the business has, and the loan, the extra money they have to take from outsiders. Okay, so what we have right here is a balance statement of financial position. So we get it right. So the next on the list, which is our statement of cash flow, right? So this schedule is meant to show the cash activities in the business, the inflow of cash and the outflow of cash, depending on the activity, right? So the statement of cash flow is subdivided into three. It has three categories. The operating activity, which involves the activities of the business, the outcome of it. The investing activity, that involves the expenditure on assets and other investments. Then also finally the financing activity involves the inflow of cash for the operation of the business. So that basically involves the capital and the loan as well. Alright, so we start off from the operating activity. So right up here, we'll plot our net profit, because net profit is as a result of the operation of the business. So bringing our net income up here, then the amount of the net income. So mind you, the net income will be in positive figure. Yes, because it's an inflow. So basically outflow of cash, the figure is stated in the negative form. So but for the inflow, any inflow of cash is meant to be in positive form. Alright, so the next up here, which is the investing activity, definitely the business invested in the mixer. So we'll bring up mixer right up here, hit our enter. The amount for the mixer definitely is going to be negative form. So we'll have our equal to, then have our minus sign, then hit on the amount of the mixer, 70k. Right up here is a negative form, meaning that it will subtract all the positive numbers. Alright, the final aspect right here is the financial activity. So we put up our capital, because capital is meant to bring in cash for the operation of the business. So right up here, the capital, then we put up the capital amount, which is meant to be in positive form. So put up our 200k right up here is up. Then the next, the loan the business took in for the operation of the business. We put up our equal to, then bring up the loan, then the amount right up here, then hit our equal to, then bring up the amount of the loan, 100k is up right here. So now let's see the total and see the implication of the cash inflow and cash outflow, so that we know what we're supposed to have at the end of the period. So we'll drag it to the point we need our summation to be. Then we hit on the summation sign. Yeah, we have 430,000 at the end of the period for the cash activity, and it's 430k. So checking up to know whether what we have is right, at our balance sheet, which is the statement of financial position, where the business stand at the end of the period, we can see right here we have the cash amount of 430,000. Definitely we have it right up here. Alright, so the next, which will not be applied to this situation because the business just started, so there was no cash balance or cash brought forward for this period, but let's have it for the sake of having it. Okay, we put up cash at the beginning of the period, beginning of the period. All right, we have period right here. Okay, but definitely it's zero because the business never had a cash brought forward from the previous year, because this is the first year of the operation of the business. So definitely it's zero right up here. Then the next, the difference between the cash outflow and cash inflow. All right, so we have cash outflow slash inflow, right? Okay, so we already ascertained them already up here. So we put up our equal to. So this is the result of cash inflow and cash outflow, which is 430,000. We drop it up here. All right. So now let's get to the final round, which is the balance, cash balance at the end of the period. How do you do that? You add up the cash at the beginning of the period, which is 0 in this situation, and the difference between the cash outflow and inflow for the period. So we drag up to the point we need our summation to be. Hit on summation right up here. We have 430,000. So this is the end of our exercise on working on the financial reporting. So we have up here, we have the trial balance, we have the ledger account starting from the source document, the income statement, balance sheet, and the statement of cash flow. This is a whole lot of about full of accounting in just a moment. All right. So the business has a whole bunch of money, 430,000 at the end of the period. This definitely states that the business is doing purely and nicely well. So enough cash inflow, a minimal cash outflow in the mixer, which is about 70,000. All right, so Mass Pastry Enterprises is a business worth doing well.